Warren Buffett has described his investment approach in a single sentence. I am 85% Benjamin Graham and 15% Philip Fisher. You know Graham. He is the father of value investing, Buffett's professor at Columbia, the author of The Intelligent Investor, the man who taught Buffett the concept of margin of safety and the intrinsic value framework that underpins everything Berkshire has ever done. Philip Fisher is the other name, the 15%. Most people who follow Buffett closely have never read a single word Fisher wrote. His name appears in interviews and shareholder letters, and then disappears, overshadowed by the more famous Graham. That is a mistake, because the 15% that came from Fisher is responsible for something fundamental in how Buffett evaluates businesses. A shift that moved him from buying cheap, mediocre companies to buying excellent companies at fair prices. That shift is the difference between the early Buffett and the Buffett who bought Coca-Cola, American Express, and Apple. In this video, I am going to walk you through the 5 core ideas from Philip Fisher that Buffett absorbed and built into his framework. Ideas that most value investors still ignore today to their cost. Idea 3 is the one Fisher considered his most important contribution, and it is the concept that directly explains why Buffett held Coca-Cola for 36 years without selling. Stay with me. Philip Fisher was born in 1907 in San Francisco. He founded his investment counseling firm, Fisher & Company, in 1931, in the depths of the Great Depression, and ran it for over 70 years. He was not prolific as a writer. He published essentially one major book, Common Stocks and Uncommon Profits, in 1958. It became one of the most influential investment books ever written, not because it was widely read, but because the investors who did read it applied its principles to generate extraordinary long-term returns. Buffett read it as a young man and tracked Fisher down for a meeting in San Francisco. He described Fisher as brilliant, quietly spoken, and deeply thoughtful. Someone whose ideas complemented Graham's in ways that took years to fully absorb. Graham's framework, which Buffett had learned at Columbia in the early 1950s, was primarily quantitative. Find stocks trading below their intrinsic value as calculated from the balance sheet. Buy them. Sell them when they reach fair value. Repeat. It worked. Buffett generated extraordinary returns in his early partnership years using this approach. But it had a limitation. Most of the companies Graham's framework identified were cheap because they were mediocre. They deserved to be cheap. And when they reached fair value, Buffett had to sell and find another cheap mediocre company, a perpetual search for the next statistical bargain. Fisher's framework offered something different. It asked not, is this cheap, but is this genuinely great? And if the answer was yes, if the business had the specific qualities Fisher had identified as predictors of sustained, exceptional growth, then fair value was not a ceiling. It was a floor. These 5 Fisher ideas are what changed Buffett's framework from a search for statistical bargains into a search for exceptional businesses. Only by businesses with superior long-term growth potential. Fisher's idea. Fisher's first and most fundamental departure from Graham was his focus on growth. Graham looked for businesses that were undervalued relative to their current assets and earnings. Fisher looked for businesses that would be worth dramatically more in 10 or 20 years, regardless of what they were worth today relative to their balance sheet. His argument: the most important question in investing is not, what is this business worth today? It is, what will this business be capable of earning in 10 years, given its competitive position, its management quality, and the markets it serves? A business that grows earnings at 15% annually doubles roughly every 5 years. Over 20 years, it grows approximately 16 times. If you pay a fair price for that growth, the return is extraordinary. If you only buy it when it is statistically cheap, when it is trading at a discount to current book value, you may never get the opportunity to own it at all, because genuinely great businesses rarely become statistically cheap. How Buffett applied it. The clearest application of this Fisher idea in Buffett's career is Coca-Cola in 1988. By Graham's standards, Coca-Cola was not cheap. It was trading at roughly 15 times earnings, not a statistical bargain. The early Buffett, operating purely in Graham mode, would likely have passed on it. The Fisher-influenced Buffett asked the different question. Given Coca-Cola's brand, its global distribution infrastructure, and the per capita consumption opportunity in developing markets that nobody was pricing in, what will this business earn in 20 years? His answer was dramatically more than the current earnings suggested. And at 15 times current earnings, the price was fair for a business with that trajectory. Today, Berkshire's Coca-Cola position has grown from $1 billion to over $25 billion, plus $9 billion in cumulative dividends. That return was not available to a Graham-only framework. What you do. When evaluating any business, add Fisher's question to your process. Independent of today's price and today's earnings, what could this business plausibly earn in 10 years if its competitive position holds? If the honest answer is significantly more than today, and you can identify the specific drivers of that growth, you have found a Fisher-quality growth business. The price you pay matters, but the quality of the growth opportunity matters more over long time horizons. Idea 2 is about management, and Fisher's specific framework for evaluating whether a management team is genuinely exceptional or merely competent. Management quality is the primary determinant of long-term returns. Fisher's idea. Fisher believed that management quality was the single most important variable in predicting long-term investment returns, more important than the industry, the balance sheet, or even the current competitive position. His reasoning: a great business with mediocre management will eventually be destroyed by poor capital allocation, missed opportunities, or failure to adapt to changing conditions. A mediocre business with exceptional management can be transformed through smart reinvestment, strategic acquisitions, or operational improvement into something significantly more valuable. He developed a specific set of questions to evaluate management. His famous 15 questions from Common Stocks and Uncommon Profits focused on whether management was honest with shareholders, whether they communicated openly about problems as well as successes, whether they had a deep bench of talent below the senior level, and whether they were willing to invest in research and development even when short-term profits would suffer. How Buffett applied it. Buffett absorbed Fisher's management framework and extended it with his own specific emphasis on capital allocation. He looks for managers who think like owners, who understand that every dollar of retained earnings must be deployed at a return higher than what shareholders could earn elsewhere. His evaluation of Roberto Goizueta at Coca-Cola in the 1980s, the man who refocused the company on return on equity and capital allocation discipline, is a direct application of Fisher's management framework. The business was good before Goizueta. Goizueta made it great. The management was the variable. Buffett has said that when he acquires a company, he looks for managers he would trust to run the business if he were going away for 10 years and could not check in. That standard management quality sufficient to sustain and grow the business without constant oversight is a Fisher standard, not a Graham one. What you do. For any company you are evaluating, read at least 5 years of shareholder letters and earnings call transcripts. Ask, does management acknowledge mistakes honestly, or do they always find external explanations for bad results? Do they set targets and then meet them, or do they consistently miss and revise? Do they allocate capital, acquisitions, buybacks, dividends, in ways that generate returns above the cost of capital? Exceptional management is observable in the historical record. It is not revealed in a single quarter's results. Idea 3, Fisher's most important contribution, and the concept that directly explains why Buffett held Coca-Cola for 36 years without selling. If you buy right, you almost never need to sell. Fisher's peak idea. Fisher believed that selling a great business is almost always a mistake, and that the instinct to sell when a stock reaches what appears to be full value is based on a fundamental misunderstanding of what full value means for a genuinely great business. His argument: if a business is genuinely exceptional, with superior growth prospects, outstanding management, and durable competitive advantages, then what appears to be full value today will look cheap in 5 years, as the business continues to compound its earnings. Selling at apparent fair value permanently truncates the compounding. He described selling a great business as one of the most expensive mistakes an investor can make. Not because the sale price is wrong, it may be fair by any current metric, but because the investor is giving up all the future compounding that would have accrued to a patient holder. The 3 valid reasons to sell. Fisher was not an unconditional hold forever advocate. He identified 3 specific conditions under which selling was rational. First, you made a mistake in the original analysis. The business does not have the qualities you thought it had. Once you recognize the mistake, sell immediately. Do not wait to break even. Second, the business has genuinely deteriorated. Not the stock price, the competitive position, the management quality, or the growth prospects have changed in ways that invalidate the original thesis. Third, you have identified a dramatically better opportunity and need capital. This is the rarest and most difficult case, because it requires genuine confidence that the new opportunity is significantly superior to the one you are exiting. Outside these three conditions, Fisher's framework says, hold. The tax consequences of selling, the transaction costs, and above all the loss of future compounding make selling a high-cost decision that most investors make far too casually. How Buffett applied it. Buffett's 36-year hold of Coca-Cola is the most visible application of this Fisher principle. Every year since 1988, analysts have at various points suggested that Coca-Cola was fully valued, that the growth story was ending, that younger consumers were abandoning the brand. Buffett's response each time was to apply Fisher's three-condition test. Had he made an original mistake? No, the brand, the distribution, the pricing power were all exactly as analyzed. Had the business deteriorated? No, earnings and dividends had continued to grow. Did he have a dramatically better use for the capital? No compelling alternative had appeared. Three conditions. None met. Result. Hold. For 36 years. What you do. For every position you own, create a written list of the three Fisher sell conditions applied to that specific business. Review this list, not the stock price, whenever you feel the urge to sell. If none of the three conditions have been triggered, the urge to sell is emotional, not analytical. Price appreciation that makes a stock look fully valued by current metrics is not a Fisher sell condition. It is evidence that you bought a genuinely good business. Idea 4 is Fisher's research method, the scuttlebutt approach that Buffett used directly when he bought American Express in 1963. The scuttlebutt method: talk to everyone except the company. Fisher's idea. Fisher coined the term scuttlebutt, a naval term for shipboard gossip, to describe his research methodology for evaluating companies. His insight was simple but radical. The best information about a business does not come from the business itself. Annual reports, investor relations presentations, and management interviews are all controlled by the company being evaluated. They present the most favorable possible picture. They highlight what management wants investors to focus on and minimize or omit what they do not. The most reliable information about a business, Fisher argued, comes from the people who interact with it daily: customers who buy its products, suppliers who sell to it, competitors who compete against it, former employees who no longer have a stake in presenting it favorably, and industry experts who observe the competitive dynamics from outside the company. How Fisher applied it. Fisher would spend weeks or months before making a significant investment conducting what he called scuttlebutt research, systematically interviewing customers about their satisfaction and loyalty, speaking to suppliers about the company's payment practices and operational quality, talking to competitors about the company's strengths and weaknesses from their perspective, and seeking out former employees who could speak frankly about management culture and strategic decisions. This research was not designed to find information that was unavailable to other investors. Most of it was publicly observable. Anyone could talk to customers or competitors. The difference was that most investors did not bother. They read the annual report, analyzed the financial statements, and formed a view. Fisher went into the field. The result was that his views on the businesses he owned were based on a qualitative depth of understanding that purely quantitative analysis could not match. And that depth of understanding gave him the conviction to hold through volatility that would have shaken a more superficial investor. Buffett's direct application. We covered this directly in the American Express video earlier this week. When the salad oil scandal broke in 1963, Buffett did not sit in his Omaha office reading financial statements. He visited restaurants and retail establishments, talked to merchants, and observed whether customers were still using their American Express cards. That was pure Fisher scuttlebutt, and it gave him a piece of information that no balance sheet analysis could have provided. The franchise was completely intact in the minds of actual customers, despite a subsidiary scandal that was dominating financial headlines. The $40 billion position Berkshire holds in American Express today traces directly to a scuttlebutt research trip in 1963. What you do. Before investing in any consumer-facing business, become one of its customers. Use the product. Visit the stores. Read customer reviews, not curated testimonials, but actual review platforms. Talk to people who use the product regularly about what they value and what frustrates them. For any business you own, periodically ask, if I were a customer, would I keep coming back? The answer from the customer perspective is often more predictive of long-term business health than any financial ratio. Idea 5 is Fisher's most contrarian claim, and the one that most directly challenges how most investors think about diversification. Concentrate. Owning too many stocks guarantees mediocrity. Fisher's idea. Fisher was one of the earliest and most articulate critics of excessive diversification, at a time when diversification was being established as the cornerstone of modern portfolio theory. His argument was straightforward. The research required to identify truly exceptional businesses is significant. If you conduct that research thoroughly, if you understand the company, the management, the competitive position, and the growth prospects as deeply as Fisher's methodology requires, then you will naturally own relatively few positions because truly exceptional businesses are rare. If you diversify widely, you necessarily own businesses you have not researched deeply. You are protecting yourself against the risk of being wrong by ensuring that no position can hurt you too much. But you are also ensuring that no position can help you too much. You have mathematically guaranteed average returns by design. The specific Fisher position. Fisher typically held between 5 and 10 positions in his portfolio at any time. He would spend months or years researching a business before buying. Once he had the conviction that came from that research depth, he would allocate meaningfully, not the 1 or 2% positions that make no difference to portfolio returns even if the thesis is correct. His most famous long-term holding was Motorola, which he bought in 1955 and held for decades as the company evolved from a car radio manufacturer into a major electronics company. The holding generated extraordinary returns, not because he traded it or managed it actively, but because he had done the research in 1955 to understand what the business was capable of, and he held through the decades of compounding that followed. How Buffett applied it. Buffett took Fisher's concentration principle and pushed it further. In his early partnership years, he sometimes held 40% of the fund in a single position, American Express being the most dramatic example. At Berkshire, the top 5 positions have historically represented the majority of the equity portfolio. His formulation. Diversification is protection against ignorance. If you know what you are doing, you do not need to own 20 companies. You need to own 5 great ones, held long enough for the compounding to work. He has specifically rejected the financial industry's standard advice of maximum diversification as a crutch for investors who have not done the research required to have genuine conviction. That critique is directly from Fisher, though Buffett applies it more aggressively than Fisher ever did. What you do. Count your current positions. If you own more than 15 or 20 stocks, ask honestly whether you have done Fisher-level research on each one, the scuttlebutt, the management evaluation, the 10-year growth projection. If you have not, you are diversified against ignorance, not risk. Consider whether consolidating into fewer, more deeply researched positions might produce better returns than broad diversification across companies you understand only superficially. 5 ideas. 1 framework. The 15% of Buffett that most investors never think to study. Let's bring it together. Idea 1. Only buy businesses with superior long-term growth potential. Not statistically cheap businesses, genuinely exceptional ones that will be worth dramatically more in a decade, regardless of what their balance sheet says today. Idea 2. Management quality is the primary determinant of long-term returns. Great management can transform a mediocre business. Poor management will eventually destroy a great one. Evaluate management by what they do with capital, how honestly they communicate, and whether the business would run well without them watching every day. Idea 3. If you buy right, you almost never need to sell. Fisher's 3 conditions for selling: original mistake, genuine deterioration, dramatically better alternative are specific and rare. Most impulses to sell fail all 3 tests. They are emotional, not analytical. Idea 4. The scuttlebutt method. The best information about a business comes from customers, suppliers, competitors, and former employees, not from the company itself. Go into the field before you buy. Keep going back while you hold. Idea 5. Concentrate in your best ideas. Diversification is protection against ignorance. If you have done the research, you do not need 20 positions. You need 5 great ones, held long enough for the compounding to work. Here is the larger point. Graham gave Buffett the discipline of valuation, the refusal to overpay, the margin of safety, the patient search for businesses trading below intrinsic value. Without Graham, Buffett would have been a reckless growth investor, paying any price for a good story. Fisher gave Buffett the ambition of quality, the willingness to pay a fair price for an exceptional business rather than a bargain price for a mediocre one, and the conviction to hold that exceptional business for decades rather than selling when it reached apparent fair value. Together, they produced the complete Buffett framework. Graham prevented the mistakes. Fisher made the masterpieces possible. The next video this week is about the single most common mistake that prevents ordinary investors from applying either framework effectively, trying to time the market. Buffett's take on this is more direct and more data-supported than almost anything you will have heard on the subject. That video is right here.